I'll bid my turn. Okay.
No, you're
That's
fine,
fine,
Judge.
Judge. We got a jump start on this, which is obviously this class is insurance premium taxes, and I want to welcome you to KACo's Leadership Institute, and thank you for joining us today. Excuse me. I'm Diane Andrews. I'm the legislative coordinator here at KACo, but I also work with training and education. This class has been approved for 1.5 hours through the Department for Local Government for fiscal court members. And as a reminder, in order to receive credit for the class, make sure you stay on the screen because we're required to track that. Just think of it as being in a class, and if you need to step away for a minute, that's fine. Just come back as soon as you can. If your feed gets interrupted, that's not a problem. Just go back to the link you signed in with and log in again. We will be sending a list of participants to DLG after the class to make sure you get credit. The best way to watch this class is in speaker mode. Go up to if you've probably done this many times during this period of time. I think we've all become somewhat of experts, or we like to think of ourselves as experts in Zoom meetings. But if not, let me just do a real quick little refresher. Go up to the top right-hand corner of your screen where it says View, choose Speaker View, and that means you'll get to see the speaker as the main video, and it'll just be easier to follow the presentation that way. We want this session to be as interactive as possible, and we want you to ask questions. And the best way to do that is to ask a question in the chat box. Just type your question. That way you'll see not only your question, I said no applies, not amongst six, but the questions of others, and you can see responses in that chat box. Or you can hold your hand up. You can do it the old-fashioned way and just hold up your hand, and we'll recognize you and put you in a queue. Or you can type in the message box, in the chat box, just say, I have a question, and we'll call on you and when it's your turn. So in addition, we want to keep background noise to a minimum so that we can all hear the presenter and hear questions. So please keep your microphone muted until or unless you're asking a question. And finally, it helps, and it looks like all the names are displayed. What I can see on my screen, of course, there are a lot of participants, but just make sure your name is on your screen. That just makes it a little bit easier on us. If you run into trouble at any time during this presentation, just reach out to us. You can do that in the chat box, or if you have someone at KACo that you know real well, say, hey, I'm having a problem, and we'll get you back on track. With that, we're going to get started. And we're pleased today to have with us Rich Ornstein, who's our staff attorney here. I'm sure many of you, particularly you county judges who are on, know Rich, and we're glad he was able to arrange to join us. We also have John Hord. John has been with the Department for Insurance since 2007, and he is currently the branch manager for local government premium tax and surplus lines there at the Department of Insurance. And John has the answers we're looking for today. So with that, John, do you want to start?
Absolutely. First, I just want to, say thank you to KACo, Kentucky Associated County, for inviting me to participate today. And I want to thank you all for showing up and participating yourselves. Hopefully today we can answer some questions. I can go over some general overview of the local government premium tax. We're going to walk through the bulletin, give you a short tour of the website on the DOI there. And then the main thing, as Diane said, is I like this to be a little bit more interactive. I'm going to try to give plenty of time at the end for you all to ask questions, for me to answer questions. And if for some reason we don't cover it today or you think of it in the future, I'm going to make sure you know how to locate me and find me. And I'm available at any time for you all to contact me if you ever need further assistance in the future. But with that, we'll get started. And as I just said, to be able to find me is the first thing I want to say. So if you ever need to, you can go to the Kentucky Department of Insurance website, and you can Google that department, Kentucky Department of Insurance. But the actual website is insurance.ky.gov, G-O-V. Once you get there, that's going to be the homepage. It's really 2 steps, really easy to find me. On the right-hand side, there's under quick links, there's a division directory. And if you click on that, it's in alphabetical order. You'll go down to local government premium tax. So look for division directory, local government premium tax, and you're going to see John Horde. My name's there, my email, all my contact information and phone number. Please feel free to contact me at any time. If you click on that local government premium tax link, it's going to take you to the subsection of the DOI website where I keep a lot of resources that you're going to find very useful. Under latest news on the front page, we have the tax schedule there. That's going to be a breakdown of what every local government in the Commonwealth is currently charging for their local government premium taxes. And that schedule breaks down by different lines of businesses too. So the tax schedule is there. The payee and address to send checks is there. But the one thing that's there that we're going to go over today is the bulletin. And I post this bulletin every year in case there's any updates or revisions. And it's about an 8 or 9 page overview of how the local government premium tax works. And we're just going to take a quick walk down through that today. Again, if we're going through and you see you have any questions at the time, you can ask. I'm going to try to keep an eye on chat. And I do see I have got a question here real quick. I'm going to answer that in a second here. But if not, again, we'll have plenty of time at the end to kind of go over if you have any questions that pertain directly to your county. The one question I do have here is what does the presence of industry necessarily have to do with relative magnitude of insurance premium tax? It's basically going to impact in ways that if you have larger companies or industry, this tax is going to be on any of their insurance premium. And so, and it's not just admitted business. This could be what's also called surplus lines business. And I'm not sure if you're familiar with that, but basically that would be any kind of insurance that could not be covered in the admitted market. And so it's an outside non-admitted carrier that covers an insurance liability that they could not get covered in our admitted business. And those surplus lines can sometimes run into the millions of dollars, if not hundreds of thousands of dollars of premiums. So one account like that could significantly impact the revenue that would be generated for the county or a city in question. So industry definitely can have some impact on your local government premium tax. That can also, there's a lot of factors with that, and we'll get into that. I know the number one question that I get asked a lot by judges is, how much can I expect, how much revenue can I expect to generate if I was to pass this? And unfortunately, there's not like a question I can answer that, an easy answer to that, because of the fact, again, 1 or 2 different policies, one company could significantly skew that number. The one thing we can do is we can look at population of another county that's similar in size. That will get you a ballpark kind of, if you look at 2 or 3 that might be in the same geographic location and population, that'll give you an idea, but really it can definitely fluctuate from county to county. So we take a little bit of precaution in giving any numbers out, because I would not want you all to project any kind of revenue or budget based on something the DOI had said, when we really, until you get it in place, have no idea what you may or may not generate. But again, we're going to go to that bulletin to kind of get started here. And right off the bat, when you get into the bulletin, it kind of talks about what is local government premium tax. And local government premium tax is been around for a long time, and it allows for a local government, basically by local ordinance, to pass for the privilege of doing business or engaging in business in their jurisdiction, a tax on insurance companies. Now, it is a tax on insurance companies, but it's also what's called a pass-through tax. And that means they can pass that tax on to their policyholders. So if you look at the statute, it is a tax on insurance companies, but majority pass that on or pass it through to their policyholders. Now, not all do, some don't, and some will, they would still owe that tax to the county. They just choose not to actually tax their policyholders with it. But either way, at the end of the day, the county would be getting paid, whether the insurance company or the surplus line broker pays it, or they pass that on through. So that's just kind of a real quick nutshell of what the local government premium tax is. It's enacted at the local level. It is done by ordinance. So it's a way for you all to generate revenue in your county. How they determine local government premium tax is one thing we work a lot with here at the Department of Insurance, because it really is driven off risk location. We have what are called verified risk location software vendors. We test their data to make sure when they plot a risk location that they know exactly where that risk location is. This is important. You cannot just use a zip code because a mailing address may not indicate where that risk location actually is. Here where I am in Scott County, you may be just outside the city limits. The city of Georgetown does have a tax. Scott County does not. So we need to use these resources and these tools, these verified risk location software, to make sure that that house is within a city limits or outside of it, to make sure we're determining who the correct taxing jurisdiction is. That is one of the number one things we run into. Is it being collected and remitted to the appropriate jurisdiction? Counties have the ability to, and this is all enacted in your ordinance, if you pass the ordinance, many exclude incorporated areas of the county. So if a house or a risk location is inside the city limits, then the county has the ability to exclude anything that's inside the incorporated areas. They are not required to. Some do, some don't. As we go through the bulletin, we're going to talk about tax code A. And a tax code A is a situation where a city and a county both have that tax. And a little bit later in the bulletin, I'm going to get a little bit more deeper into that, and discuss that relationship and how that works. But for now, that's in this portion of the bulletin. Determining where that risk location is paramount to making sure that it is being collected and remitted accordingly. We have what I use here at the Department of Insurance, and if you all ever want to use this tool, I find it very useful. It's called the Incorporated Cities Map. It's done by the Commonwealth Office of Technology. You can Google search Kentucky Incorporated Cities Map, and it works like Google Earth, basically. My name's on there when you get in there, little splash screen, but you put in your address, you hit enter, and it's going to give you a satellite view of where that risk location is. If it's within a city, the city borders are actually outlined in yellow where you can see it, but you can also click on a building or a house. And if it comes up with the information, this is the Incorporated Cities Map. So it'll tell you what city that house is in and what county. The city areas are also shaded, so out in the county it'll be clear. But basically, you're looking for that yellow dotted line to show you where the incorporated city limits are. It's a very useful tool. When people contact me, I can plot that and pretty quickly tell you if a location is inside of a city or outside of it. And in areas in northern Kentucky and around Louisville, it's beneficial to, when you get places like St. Matthews or these home rule cities that are very embedded in these larger cities, you can definitely tell what the taxing jurisdiction is. So again, I use that here at the Department of Insurance, but that's how we determine where the actual local government premium taxing jurisdiction is. Get a drink of water here as I ramble a lot, so I'll apologize ahead of time. Once it is determined that there is a local government premium tax, if a policy is going to be placed, they have to disclose that on the policy. It's either got to be on what's called the DEC page or the declaration page, or some kind of billing instrument that they use. And it's going to actually identify the county or the city on that DEC page. They can't just put municipal tax or local government premium tax. They actually have to identify the local jurisdiction that they're collecting that tax for and remitting for. There may be multiple in the cases of a tax code A, or in the cases of what we'll talk about a little bit later too, what's called divisible premiums. And that's basically where you have multiple locations. We're in Kentucky, horses tend to be covered. You may have horses that are in different locations within the Commonwealth. If they break down their premium, basically divide it, divisible premium between those different locations of where those horses are kept, each one of those premiums will be subject to the local government premium tax where that horse is. And so that's kind of how that works as far as a divisible. But again, with the disclosure, they would have to then disclose each one of the local governments where they collected and remitted the tax. Again, that's important because for your constituents, they should be able to look at their policy holder or at their policy and be able to see, I'm being taxed for this county or for this city. That information is very important for them because that's how I get contacted a lot by policyholders saying, I'm being collected for ABC city, but I live in XYZ city or county. And so that does happen. The verified software we use has a threshold it has to meet, but that doesn't mean that it's technology, that certain ones don't fall through the cracks. So we do work with the policyholders, and I make sure to get those corrected. Let's see here. It's termination disclosure. Section 4 kind of gets into what I was talking about with the surplus lines business. That's that non-admitted business. There's certain portions of the bulletins that really are more for the industry side, but there still might be interesting for you all to kind of get a good picture of who would be sending or collecting or remitting on your behalf. And that's what these surplus lines brokers are doing. They are also, just like an admitted carrier, they're an individual surplus lines brokers are licensed that way. So they're going to place that business, they're going to collect it on your behalf, but they'll also need to remit it accordingly and file accordingly. Your admitted carriers, Kentucky Farm Bureau, Allstate, State Farm, they're all going to do one for you. You're going to get one check from them. You're going to get one report from them. Your brokers will come in under their individual license. So at the end of the quarter, you'll get checks from these brokers that have placed business within your taxing jurisdiction. And so we have some filing guidelines that are specific to those brokers there. Kind of get into the exemptions next and exclusions. We outline them here. They're in statute. There are exclusions in statutes. Now, each county and their local ordinance, and when you pass your ordinance, you have the ability to exclude anything else that you wish to. An example would be Lexington Fayette. They exclude livestock. So there may be certain parts of industry, or some do agricultural, they exclude farming. That's completely up to you to write in your ordinance what you wish to include or not include or exclude. But there are statutory exemptions. Some examples of that: individual health is always going to be excluded. Workers' comp is always going to be excluded. Federal flood, and the list that we break down the list. Those are statutorily in the statute. Those are excluded. You don't need to put you don't have to do anything with that. You may add to that list if you wish to for an exclusion at the level. One question we get a lot are about 501Cs. They are not excluded from local government premium tax. They are excluded from the Kentucky surcharge, which is the 1.8%. And I think people get confused on that at times. But just because it's a nonprofit and a 501C federal exclusion does not exclude it from the local government premium tax. Again, that's something if a county wished to, they could write that into their ordinance but it is not required. So that's through the exclusions. One of the ways we help them to determine that is on that tax schedule I was explaining. The first column in the tax schedule has what are called tax codes, and you'll see them from tax code A, B, C. They're alphanumeric. The numbered ones line up and correspond directly with a certain county or city. I think there's 52 of them now, I believe 52 or 54. But that's when a county or city has excluded something, and we add that to our tax code descriptions. And in that first column in the tax code, it's going to have a number there right next to Davies County or whatever it is there. Then they can then go to the tax code description to see what that exclusion is. It corresponds directly with that city or county. And you can, that's how you work the schedule and what we call the tax code description together. They're both always going to be on the front page on the Department of Insurance website of the local government premium tax portion. So you go to your schedule, if you happen to see it, and you'll see a number or a letter next to it, then you can go to the tax code description where we have outlined what that is. I'm the one who actually loads those new tax code descriptions. So if you pass an ordinance, if it's pretty clear what it is, I may follow up with you to make sure that you take a look at what I'm putting on the tax code description, that it's in line with how your intent or interpretation of that additional exclusion may be. Recently, I've had a county I had to reach out to, and it had to do with some of their language with agriculture. And they provided me with just a letter that I then can send out to industry when I'm asked about it, of what their actual intent and interpretation of that is. Because we want to be consistent here at the DOI. I want to give the same answer every time when somebody asks, what does the county or city mean by such and such exclusion? So if you add an additional exclusion, I may reach out for that if we have to add a tax code description. Go ahead.
John, could I interrupt you? We have a
Absolutely.
question in the chat box, and he wants to know if there is a difference in the rate between the types of industry.
No.
No
The
difference.
rate is set by the county or the city. It's not broken down. When an ordinance is passed and you pass your local government premium tax, you're actually going to set it for the line of business. Is it casualty? Is it automobile? That's how the tax is actually passed. The type of industry has no bearing on the tax amount. It's either an excluded or excluded business. As it doesn't go for the business; it goes off the type of line of business that it is. A lot of counties and cities will exclude health. But regardless if what your industry is, whether you're selling widgets or you're a railroad or how any of that works, you're subject to the type of policy that it is. So if it's a casualty or liability, it's a certain thing. So yeah, your actual type of industry or business you are really doesn't have any bearing. It's more of the line of business or the type of insurance it is that would exclude it or could change that. But that's a good question. Thank you.
Yeah.
And I'm sorry, and Diane, you know me, we've talked enough times. We start talking local government premium taxes, I'm just going to keep on going. So I try to pay attention to the chat in the hands. Sure. I'll try to give some breaks here and there for you all to jump in. The last one, I do want to say a little portion on that exclusion. This gets brought up every once in a while, and it's important for the county to know this. And it's a little caveat there. It says, unless otherwise excluded by local government ordinance. So basically, unless the county excludes it, a city is not exempt from payment of county LGBT. So that would include city policies and coverages. So I get that asked a lot. The city doesn't have to tax itself, but that doesn't mean that a city policy is excluded from the county. The county would have the ability to exclude that. So just one of those things that, again, is a clarification. The next is the indivisible premium portion of it. What's actually in the bulletin is more geared toward the industry to let them know if they have a divisible or indivisible policy between fire and how that's broken up. But we use that divisible and indivisible term also, which is the one I want to clarify for you all, is if there's multiple different counties involved. If that premium, when they collect it, if you've got two different counties, and when they collect and underwrite the policy, if they determine that premium based on those two different locations, that's divisible. They've divided the total premium between the two counties. And in that case, they would tax those premiums accordingly. Each county would be looked at whatever that portion or tax, and they would collect it and remit it to those two different counties. If when they underwrite it and they don't divide the premium, it's non-divisible, it's one premium regardless of where location is, then it's wherever the master policy is. So if the master policy is actually in County A is going to get the tax. It's not going to take County B into any consideration. So that's divisible, indivisible premium when that comes up. One thing with life insurance, many counties and cities exclude life insurance, but if you decide you want to collect life insurance, it's only going to be for new policies for the first year. You will not receive any local government premium tax at renewal. It's only on new business and for the first year. That life insurance is the only kind of line of business that does. That's the only insurance that has that caveat. Question? Heard something real quick? Okay. You all can also set what's called a minimum tax. This gets into place when, and especially nowadays with what it costs to actually administer this tax. Many you'll see it like a $5 or a $10 minimum tax. Basically what that's saying is regardless of what you set the percentage at, if it's less than $5, you're going to send me at least $5 for that policy. I think counties and cities are running into a situation where they'll get a check for $1.33. Well, it costs them more to cash, administer, do the banking with that check than what they're collecting in taxes. So something to think about. You do have the option to have a minimum tax. And you can set that threshold wherever you would want to. Again, it could be $5, $10, but that's what the minimum tax is. You're not collecting both. It's going to be an either or, the greater of. So it's either going to be $5 or the percentage of whatever is set. And again, it's the greater of those two, but it would never be below your minimum tax. This kind of also brings up what are called flat fees. Instead of doing a percentage, you can just set a flat fee. And in this case, it's a little bit different because the insurance company cannot pass on a flat fee. That would be, if you say it's a $20 or $25 flat fee for that coverage, that is paid by the insurance by the company. And that's what it is, regardless of how much premium it is. It's just a flat fee. Any questions on any of that real quick? Sometimes that generates a few questions. And I'm going to open it up at the end too. So,
yeah, I have a real quick question. I just want to make sure that I understood what you just said.
Sure.
That if a county enacts an ordinance to collect an insurance premium tax, but does so on a flat fee per policy, that fee has to be absorbed by the insurance provider. It cannot be passed on to the customer. That's
absolutely correct. Yes.
Is there a maximum that the flat fee can be set at?
Not that I'm aware of. I think I see most of them around $25 or $20. And in statute, I don't know. I get that question. There's not a lot of caps. You can set your rate at where it is. So no, the one caveat, the one thing that the flat fee is, it's per insurance company and not chargeable to the policyholder. That's one that cannot be passed through. Now, again, you take your percentage out of it. You can't do percentage and a flat fee. It's going to be one or the other. And you can also do that across lines of business. You don't have to do that all the way across. So you could still have your automobile at like 3% or 5%, but then have one of the other lines of business at a flat fee. And if you want examples of that, if you take a look at the tax schedule, there's a couple counties and cities that have done that. And you can kind of see what other local jurisdictions have done to where they have that a percentage for some of them, but a flat fee on a certain coverage. And so that's out there. But you can't like have automobile have both of them. So
Right.
one or the other. But yeah, that's how the flat fee would work.
Well, what about a municipality with a insurance premium tax in place already, and a county were to decide to do it? Can those taxes be stacked, or is there a maximum percentage that can be added to the insurance premium?
Well, the way the tax, and if you're talking about, if I understand your question correctly, is like the city and the county both would have a tax. We're going to get into, we're getting close to what's called that tax code A. And if the city is lower than the county and the risk location's in the city, they're going to pay the city first, regardless of what the county does. They're going to determine that city. If the county's higher, they're going to get a credit for whatever they paid the city, and the difference is they're going to owe to the county. So they're going to adjudicate that tax kind of in order of if it's a location in the city and the city has that tax. If you had a flat fee, they're not even going to look at your flat fee until they do the city portion of it first. And if that's going to be above your flat fee, then they'll get the credit for the amount that they pay or percentage that they paid in the city first. But we'll hit that more on tax code A. But, thanks again. That's another good question that comes up too. And I'm going to apologize to anybody in here who might be a judge. And if I don't call you judge, I definitely don't want to short anybody, and understand that you're legislative officials in here. And I do appreciate your time.
And John, we have another question in the chat box.
Uh-huh.
What is the proper term for the flat fee, and where can that be found in the provided materials?
Yeah, it's actually just called a flat fee. It's that is the term for it. In the bulletin, it's section, what I'm walking down through, it's actually in subsection 9, Roman numeral 9 of the bulletin that you can take a look at. But that is the term for it, is a flat fee. The statutory authority for or statutory site for it, I'd have to get in and find that. We try to use with the bulletin, we take out a lot of stuff out of the statute and include it into the bulletin, which makes it a little bit easier for people to locate and read. But if you would want to get that in statute, I could follow up with you at some point to find the actual statute on that. But the term is flat fee. It's just a flat fee.
And John, there's one more question. Mm-hmm. Are there any tools used in projecting revenue or project revenue if you're establishing a flat fee or a percentage?
Yeah, to project the revenue, there's really not. That gets into that whole. It's tough to do a projection. You can look again at relative other counties to your look at the 2010 census maybe and get an idea of what a very similar sister county to you all may have collected previously. And that still, I would really take that with a grain of salt. You may get more, you may get less. Is one on a lake? Is one on the river? Does one have different size industries? So population is not always going to be your driving factor. And again, you could get into one of these situations where you have a non-admitted business surplus lines policy. And it just takes a couple of those when you're looking at a quarterly function that could really skew what you're bringing in or what you could use on your budget. Also understanding these can fluctuate up and down. They stay somewhat consistently, but if you lose any kind of industry or you lose any kind of policy like that could impact or have effect also. So yeah, it's tough to project revenue. And I do know that is a definite question we receive a lot. But until you get it in place and really start collecting that local government premium tax, get yourself about 2 or 3 quarters under your belt, and then you can kind of start to gauge what you could do as far as a budget goes. It really is just, you got to kind of get it in place and take a look at what you collected and what's been remitted to you. But again, thank you. Next, after we get to so after flat fees, we get into collection fees. This collection fee is, again, at the industry, pointed at them. This fee is in addition to any local government premium tax, what you set. So if a county sets a 5% tax, and let's just, for easy math, let's say there was a $100 premium. So it's going to be $5 local government premium tax is going to be collected and submitted to the county. An insurance carrier, the insurance company or the surplus lines broker, can add an additional 15%. Well, it's either 2% of the tax of the premium or 15%, up to 15% of the tax collected as what's called a collection fee. That's what they get to collect for the administrative side of having to collect and remit the tax on behalf of the county or the city. So it would be, say it's up to 15% of that $5 is what that would be. So that's an additional collection fee that would not be sent to the local government. That's actually what the carrier by statute is allowed to charge for administering the tax. Get a lot of questions about that because they'll say, well, I'm at 5%. Why do I see that it's above that? And it's due to that collection fee. Again, not required. Some companies do up to the 15%. Some don't do a collection fee at all. They build a lot of that into when they're determining where their premium is. It's private industry out there, so they're trying to make sure when they're trying to sell a policy or place business, sometimes they'll eat that themselves instead of passing that on or including a collection fee. So that's what that collection fee is there.
John, there's a request for clarification.
Mm-hmm.
So the collection fee is applied to the flat?
No, it would not be in that case because, or on the flat fees, you mean? Because the flat fees, because the flat fees are
percentage.
Yeah, it's just going to be on the percentage because, here's the two things with that. One is if you're talking about the minimum tax, they can do the collection fee on that because the minimum tax is the minimum tax or the percentage rate that you put in place. The flat fee is the one that you cannot pass on to, that's paid directly by the insurance company. So there's not going to be a collection fee involved in a flat fee because they're not collecting it from the insured. They are actually, the only time you're going to have a collection fee is if they're actually a minimum tax could be subject to it because the minimum tax, they're still collecting that from a policyholder. The same way as a percentage would be. So you got to remember minimum tax and percentage are the same thing as far as what they're charging the policyholder. A flat fee is what you would put in place just to, if you put a $20 or $25 flat fee per policy on the insurance company. That's if they can't pass that flat fee on. So it's two different things. How do you monitor for flat fee collection accuracy? That's auditing. When you would have to come back in, they have to still, when they do their annual reconciliation with the Department of Insurance, they would say how much that they remitted to they do that filing with us, and it would say Jefferson County, this is how much we pay total. And so you've been collecting that quarterly from the insurance company. You'll take your quarters, bounce it again, what they say total premium and total, they have to break that out at the end of the calendar year, how much they say they paid in local government premium tax. So you would take everything you have received throughout the previous calendar year by quarter and run that and audit that against the annual reconciliation. That's kind of how it's all done as far as the audit goes. The Department of Insurance really doesn't get involved in the auditing side of it. Again, by statute, you can request if you believe that there's a discrepancy that you've located, but you would definitely want to have done your due diligence on your side to make sure that it would be financially beneficial because it would be at the cost of the local government for the Department of Insurance to do that audit. So you would want to check that. Flat fees are per quarter, the same as anything else. Whenever they place a policy, whether you have a flat fee, whether you have a minimum tax, whether you have a percentage tax, all of these are collected in the quarter that the policy is placed. So if you place it in quarter one, like one went in today in Q1, whether it was whatever kind of fee, a percentage, flat fee, whatever, that's going to be collected when they place the policy, because it's still going to be disclosed on the disclosure on your deck page. So they're going to collect that. They're going to then remit everything to the county at the end of the quarter of policies that they place. All the money they collected in that quarter, they're going to remit all of that within 30 days of the end of the quarter. And as far as could a flat fee on an auto insurance policy be as high as $100? I would have to get in there and get back with you on an individual. Like I've never seen one that high, and off the top of my head, and I don't want to give you any misinformation, but I'm not aware of a cap on flat fees. Again, I would want to take a look at it on an individual basis on that and make sure, but just from reading through the statutes, nothing jumps out at me that there is a cap on that. So, but again, I would want to look into that. Do they also report the totals of each insurance? i.e. home? Yeah, they break out. What will happen with us, with the Department of Insurance, when they do their annual reconciliation, they break it out by line of business, how much totals they've collected. So it's complete totals that they collected for that calendar year. That's in the annual reconciliation at the end of the year. Now, when they do their quarterlies, they're going to send you, and we're going to get into a lot of what's called the LGT 141. That's the cover page that they send with their checks. So the local government, they're going to collect it, and then they're going to collect all the policies for the county, and then they're going to send the county one LGT 141. It's just basically a demographics cover page, and it's going to say Kentucky Farm Bureau, and it's going to have a breakdown of all the different lines of businesses, and then how much premium they collected per that line and how much premium was there. And you'll get that with the check that's remitted to you. So they explain that it's a breakout, itemized of how much was collected for each line of business. Can we the breakdown of what type the city would be made over the county? Yeah, we're going to get into the tax code A and B, which is what I think you're talking about. Which we're getting to tax code A. Yep, that looks like, because given which one had the high rate. Yeah, that's going to be a tax code A situation. We're going to cover that here in just a few minutes. Excuse me while I get a drink of water real quick. And I know we are covering tons of ground here. Local government premium tax in Kentucky is unique. It really is. It's got a lot of facets to it. So do not, again, hesitate to contact me on this stuff offline, email me, call me. I'm always available to try to work with you all so you understand what you're doing. So that's not a problem at all. But I do definitely realize that there's a lot of moving parts here, and you all have a lot of questions with it. Going to get into the appeals. How popular is the flat fee and how many? Not the flat fee is not used that often. Again, we could take a look at the schedule. I might actually have it up over here real quick. Didn't like it when I moved here. Diane, am I still there?
You are.
Okay. Sometimes I want to make sure I don't close out on you.
You're still here, John.
All right. I don't have for some reason, the internet's not wanting to do both of them at the same time. So I don't want to close out of the meeting, but there's not a lot of flat fees, but if you go to the schedule, it'll actually say flat fee next to it. And most of them are $25. It's not very popular that it's out there and done. And it's probably because of the fact you got to remember, once you lock that in, you're locked in for a fiscal year on that. And if you ever need to change these, they do need to be changed by ordinance, amended ordinances. But again, that's how you all would want to write it. But for whatever reason, the flat fee is not a popular one. And it could be the fact that trying to determine what that flat fee would be. So again, it's not real popular. It's not used that often. It's normally a 3%, 4%, 5%. I think it goes all the way up. I think the highest one we have right now is like a 15% local government premium tax. And the number one question I get on that, is there a cap for that? As of right now, no, there's not. I will say that it appears the local government premium tax has been gaining traction more and more. It's a way for the local governments to get revenue, and basically they can apply it themselves by just doing a simple vote with their fiscal court or their city council. I think one of the questions that was asked also is how many. I think we're about 44, 45 counties right now that are doing the local government premium tax, and I've seen that more are coming on. The counties and the cities are looking for revenue. It is what it is. And so it's becoming a way that a lot of the local jurisdictions are being able to increase their revenue.
John,
yep.
If I could just interrupt just one more time.
Absolutely. No, you're fine.
I wanted to let the participants know that if they'll check the chat box, there's additional information being added into the chat box for their information.
Mm-hmm. Yeah. Yeah, you can stop me anytime. I'm here for you all. So.
Oh no, you're doing great. You go ahead. I just wanted to remind the participants that we are adding information into the chat box for them related to this subject.
Going on to the appeals, this is where what will happen is if there's ever a discrepancy, they pay too much, they pay too little. It gets into adjustments of how they need to do amended returns, and that's got a lot to do with the filing. A lot of that's on the insurer's side of it because they're the ones who are doing the filing. Really, the counties, once you all have your ordinances in place, administratively, there's not a lot of requirement that the counties or the cities have to the Department of Insurance. That's all the burden of the insurance companies and the surplus lines brokers to file with us. We do get a situation what's called unearned premium though, to where there's a cancellation because they're going to collect your premium tax up front. They're going to place that policy, they're going to collect that tax, and then they're going to remit it to you within 30 days at the end of the quarter. Well, say 6 months in, the policy cancels. That's going to create what's called unearned premium. And they're going to have to refund, the insurance company is going to have to refund back to the policyholder the amount they collected on a pro rata basis. And it's done at the same rate that it was collected. So if there's ever a situation where a county was at 6% and then fiscal year changed and went to 7%, whatever they collected it at is what they're going to return it at on a pro rata basis for as long as that policy was in effect. The county then, they're going to notify you that there was a cancellation. They're going to take that as a credit, whatever that amount of refund is, they're going to take it as a credit on the next quarter and carry that forward for up to 12 months. You all can carry that credit for 12 months. It just saves money going back and forth. Like there was a credit, now we're sending you money, now you send it back. So if they have business in the next quarter, they're going to offset whatever that refund was with any new business they have. And it just creates a credit going forward. After 12 months, if they've not placed any more business and that credit's still out there, they'll reach out to you with information of the policy, when it was canceled, all that, and let you know that they're requesting a refund. So after 12 months, then you would cut them a check if they had not placed any more business that created an offset where that credit was used on any new business. So that's kind of how the unearned premium, again, it just keeps money from going backwards and forward. Let's see here. We got some chat going on. Let's see here. Current local government premium tax schedule. Can you email me links after? Yeah, we can. I can contact anybody wants any email links or DOI links. We can get that out to you. That's not a problem. Has an insurance company decided to quit business in a local government? I'm not sure I understand that question.
I think he means because of premium tax.
Well, no, I mean, the insurance is out there. A lot of this is going to be driven by your home and auto, which are both required to be, if you own a home or you own a car, those are going to be insured. So they're going to collect accordingly. If they're doing business in Kentucky, they're going to collect and remit it pursuant to statute. I'm not, now we may have some, I can tell you that I have surplus lines brokers who won't do business in the Commonwealth because if they're only doing one or two, now this is non-admitted business. Admitted business, that means they're licensed here in Kentucky. Your Kentucky Farm Bureaus, Allstate, State Farm, they're here. But there's individual license that have placed a policy here and there, and they've flat out told me that they don't want to do any business in the Commonwealth because of the local government premium tax. But that's an individual broker. That's their choice if they want to do that or not. But I'm not aware of any companies that have not done business in a local government because of the tax. And see here. Would the flat fee be charged only once per policy? Yes, it's per policy. It's when they place the policy. Or is the policy? Yeah, all of the taxes, the way the local government premium tax works is as soon as they put that, they're gonna place a policy, they're gonna send a deck page or a declaration page. It's gonna have whatever the local government premium tax is, plus the surcharge, and then plus it has to all be broken down. And so that's all gonna be collected at one time, and then they're gonna remit that within the end of the quarter. Okay, now we're to that tax code A. This is where it gets interesting as far as tax code A, tax code B. And this is where the city and the county both have a tax. Right now, we have about, I think there's 9 counties in this situation to where it's really the relationship between the city and the county. And if the city has a tax, and we'll use Bullitt County just because they're relatively new to the tax code A, and I think they have 6 or 7 different cities that this impacts. If the city has a 5%, which I know they do over in Bullitt County, and Bullitt County has a 10, any risk location in the city is going to first collect that 5. They're going to collect that 5% first. They're going to collect it on behalf of I'm trying to even think of what I'm now, Fox Chase, Hebron Estates. They're going to go ahead and collect that 5% and send that to the city. Now, Bullitt County has a 10. Bullitt County is not going to get that 10. They're going to get the 5% because the 5% of the city is going to be what's going to get credited. So the city's going to get their 5%, and then the county's going to get 5%. What they'll do is when they do their quarterlies, they're going to send an LGT 142. It's like the LGT 141, which you'll get one of those too, but they're going to send an LGT 142, which is for tax code A. And it's basically saying, hey, we had this policy in a city in your county, and we paid them this much. And so we're taking that credit against the county tax. So that's where the A comes into place, is it's always when the city and the county both have a tax, the city is always lower than the county. If the city's higher than the county, they're going to just pay the city and the county won't get anything. This only happens when the city's lower than the county. And that's with tax code A. Tax code B, you're not going to have to worry about that if you don't have one in place. That's our grandfathered counties. Those are ones, there's only a handful of them, but there's three counties left: Anderson County, Fulton County, and Washington County. And basically, if you're in one of those cities, you're going to pay the total of the city and the total of the county. So in that case, if it was a 5 and a 10, you are going to pay 15% because you're going to pay 5% to the city, 10% to the county. Those are tax code Bs. They're called our grandfathered areas, tax jurisdictions. So, and I think it's after 1991, anybody that came into place after that, they would not be in that. So if you're not a tax code B now, you never will be. So that gets a little confusing sometimes, but that's kind of it in a nutshell, how that relationship works between a city and a county. Basically, the city's going to get paid first, and the county is going to get theirs, whatever, if there is a credit afterwards. Do you have any questions on that? Okay. Again, if you all think of anything afterwards, you can contact me at the Department of Insurance anytime. Next, we get into the quarterly payments. Again, it's going to be paid within 30 days of the end of the quarter that they collected in. They're going to give them the policyholder. They're going to collect it when they collect the premium, and then they're going to remit it directly to the city. The Department of Insurance does not see, is in no part of the collection and remitting of the tax. It's collected by the insurance company and remitted directly to the local government. We provide a payee an address document to where they can look up the county The county lets us know who they want the check written out to and where they want the check sent. Other than that, the Department of Insurance does not have anything to do with any of the payment of it. It's directly between the insurance company and the county. That's kind of why we're not in the auditing of it either, because we don't know what is being paid to the counties or the cities directly, because of the fact that it is a local government premium tax. In the cities and the counties, it's really in between them and the insurance company of what's being paid. But yeah, within 30 days now, there are penalties on that. If they pay late after the 30 days, revenue sets it, and they'll change that periodically. I think right now it's at 7%. I don't think they've changed it for this year. So if they're paying outside of that 30-day window, there will be a 7% that revenue puts on it as interest. And then the county or the city, if they wish, can add a 10%, up to a 10% penalty on top of that. That's up to the county when you receive it. And if for some reason the insurance company didn't pay if you had a 10% penalty in addition to, you can contact them and say, we received this outside of the 30-day window. It's subject to a 10% late fee. Again, that's up to the county or the city, the local jurisdiction to do that. But it is permissible. The next part, we get into the annual reconciliation. That's that calendar. I'm actually doing it right now. Every year, at the end of the year, every insurance company and every surplus lines broker needs to file with me the annual reconciliation. It's incredibly important to the local government premium or to the local governments, because that's how they do their audit. They need that information so they can look at what they received quarterly in the prior calendar year, and they'll bounce that against our annual reconciliation. And that's how the audit is done. And one thing I also do is we have what are called non-filers. If March 31st comes, within about 30 days to 60 days after March, sometime in April or May, I will send out a letter to them, which are called non-filer letters, letting them know they're not in compliance. They will get 2 of those. After the second one, I get involved with legal, and we send out administrative action legal orders up to and including suspending and revoking their licensure. We take it very serious that we need these reports, because we understand that the cities and the counties need these reports to be able to do their audits. And kind of how Judge Summers and I started off at the beginning of this, and that's kind of how we make sure you all have the tools and the resources to make sure you can see what is actually being sent to you all. Premium totals are also sent to NAIC. So that goes all the way up. So we do an external audit on like our surplus lines brokers to where we can see what they're filing nationally against what they're also filing, what they're saying they're filing annually with us. So it's a lot of checks that kind of go up the ladder from there. But for you all, it's very important that you have as correct of information on your annual reconciliations as possible. And so I make sure that they're filing them, and I get out there on your behalf to make sure if they're on my non-filer list, I will chase them down. And then once it gets to a point, they would actually go through our legal division. Legal orders are signed by the commissioner, again, up to and including revocation of their license. So we take it very seriously. Those are all done electronically online now too. That used to be done through paper, but we're trying to basically streamline and make it everybody's lives a little bit easier with some of this by giving them the tools and the resources to go online and be able to do those and upload them instead of having to mail them in. I think that helps out. Kind of wrapping things up as far as my portion of it here to get through this. The local government e-services portal, I want to bring that up. If you're not signed up for that for your local government, please contact me. I can do it online over the phone with you. Basically,
John, I have a couple of questions.
Oh, sorry. Yep, I was going again.
Okay. I couldn't figure out when would be a good time to interrupt you.
No, you just got to jump in there and go, hey, John, stop for a second.
So we have someone asking, what would you project as a cost of compliance with the Department of Insurance?
Let's see here. What would you project as a cost of compliance? I'm not sure I understand that question, Mr. Sims. What would you project as a cost? Are
there fees associated with?
No, as far as for the county? No, none at all. And once I wrap this up, I'm going to kind of go through like what you'll need to do as far as to get it in place if you don't. But again, there's the local e-services portal. As far as that goes, we're in the window right now. If you don't have an ordinance in place and you're wanting to, the only time that we let them get on there is the beginning of July 1st, the beginning of a fiscal year. Let me look at these other questions real quick. Counties must report that late payment to Public Protection Cabinet. Oh yeah, that's possible. I'm not familiar with that side of it, and I wouldn't want to get into as far as how those late payments are done. But I'm sure there is some. If you decide to do that, there is some reporting that has to be done. Again, I'm not any part of the collection or payments or fees or fines or however you all want to do that side of it. But the important thing coming up is 100 days before July 1st, we have to have any new ordinances or any amended ordinance to the Department of Insurance. We do provide a template. It's just basically a blank that you can, it has a bracketed variable language. You can plug in your county, how much you want your tax to be, and kind of go down. That's on the Kentucky Department of Insurance website, that area that we were in, underneath the forms and documents portion of it. If you can't find it, just let me know. But more than happy to get a copy of that to look at. It's just a standard template ordinance that you basically plug in your numbers and how you would want that done. But again, we need that 100 days before July 1st. There's really nothing we can do about it. If we get it 99 days before July 1st, it will not be part of the next fiscal year. We have zero wiggle room with that date. So that's March 23rd this year. So we're talking, less than 30 days from now. So if you've not got one in place, you would have to kind of get moving, because I believe in KACo KACo could help with this as far as doing perfected ordinances. I believe you have to have your first and second readings, and then they have to be posted also. But again, I don't want to get into too much of that, as that's not the Department of Insurance's side of it. But we're getting close to that March 23rd date.
Rich, do you want to weigh in?
Mm-hmm.
I'll be honest, I think most of our folks probably by now know how to do an ordinance, but because there was a change last year, you actually have more time than you would have in past years. Remember, there's no requirement now that you advertise between first and second readings.
Okay. So
you can do your first reading on day one. In theory, if you had to, you could do the second reading on day two. You are still required to advertise within 30 days of passage. But once you do your second reading and it's passed, you could then go ahead and send it on into insurance as it's already valid. The advertisement 30 days after, while required, is an administrative function rather than a bottom line is, after the second reading, send it on in to John to make sure that you get it taken care of.
Yeah.
And if you have questions about that, I also have a couple other ordinances that other counties have done that comply actually with the model, look almost exactly like the model. Feel free to email me. I'm happy to get them to you.
Yeah, and I noticed, Rich, Jennifer just posted a model local government premium tax ordinance.
That's the DOI model. That is the DOI model. It's the link to it.
Okay.
Okay, and I just realized I got to scroll down here to some of these questions. If a county percentage is 3% in the city and the county is 7%, do residents of the city pay 7%? And what is it? Yeah, so in that situation, where the county's lower and the city's higher, again, that would just mean if the risk location was in the city, you're going to pay just the city. The only time the county is going to get any portion of a local government premium tax is if the county is higher than an incorporated cities. And then they would pay the city first, and then the county would get whatever that different portion would be. Public utilities, if they are an agency of the county, or in this case, if it's county-owned property, yeah, you're not, the county's not going to tax itself, the city's not going to tax itself. So if they're an agency of the county or of the local government, basically, they would be exempted, again, because, county's not going to, county airport, if county owns the airport, they're not going to tax an airport that they own. They're just going to pay, they would just tax to pay themselves. Can we sign up to access the ePort as individual commissioner? what happens is, as long as you are in some capacity of the judge, one of the elected officials, one of the fiscal court representatives, in some way you need to be able to, when you contact me, show basically, usually by email or you contact me, that I'm representing the county, because it's going to be the county's portal. Then yes, it's not a problem. It's not an individual. It's not an individual account. It's actually there's one account. Just people can have logins to get into it. So we'll set that up for a county to get into. So there's not like an individual commissioner's account or anything like that. It's just we have an account on e-services for the county, and we can set that up to where you can get permission to get in there. Model, okay, that's there. Is that the same as the flat fee tax? Yeah, as far as the flat fee goes, again, I'm going to want to get, there's not a lot of people with the flat fee. And so I know that it's there, and it's one of those ones that I think most of them are like $25 are the ones that just jumped out at me. I wish I could get into my other one. I'm afraid I'm going to close out on you if I go. There we go. Anderson County has one. That's a minimum tax. That's not flat. The flat, you'll actually see it'll be buried inside the schedule. And I don't know that I've got a hard copy.
My question there is, I know like in our county, the city has like a 10% premium tax.
Mm-hmm.
And if the county enacted a percent tax, say at 5%, I know we wouldn't collect anything off of residents or industry or business inside the city limits. But if your tax was a flat fee tax, would you still get that flat fee tax, or would the payment on the city percentage supersede even the flat fee tax?
If their credit is more than your flat fee, then they're not going to owe the flat fee. It's going to be, the flat fee is just, instead of the county saying we're going to go off a percentage, if that's less than what they've already paid to the city, you're not going to get that flat fee. No. If I'm understanding your question correctly. Yeah.
Yes, that's correct.
Hey, John, to kind of add to Mason's story there, if the city is 10% and the county's 5%, and ignore the fee thing for a second, but if the city's at 10% and the county's at 5%, and the county went to 11, then the county would be the higher percent. So what's going to keep the city, and I hope there's not city people, and I'm not trying to start an argument, but what's going to keep the city to go to 12% the next year, other than just politics?
And they do. I mean, I can tell you right now, and it's going to be for public record, Bullitt County went to 10 and 5, and I believe I've already got some ordinances that are coming in that they'll raise the match.
So it's just a yearly battle in politics.
I don't like to get into the political side of it.
I mean, I didn't mean it that way, but you know what I mean.
No. Yeah,
each governmental agency can just go every year and go higher and higher if they choose to. That tends
to be, that happens. I'm not going to say it happens all the time, but yes, if a county, a county raises, because I know that the city, everybody lives in the county, but the city's getting all the taxes and the county's paying the bills, and so the county tries to get some of their money, and then the city goes, wait a minute, the county raised it. Well, since the county's already got the tax up there, we might as well raise ours to what the county's at, and we'll just keep that portion up for the city. So that does happen, yes. And normally it happens just, pretty quickly. Once a city sees that a county has raised theirs, we'll get an ordinance pretty quick to have that city raised to meet whatever the county is. Not always. Obviously, that's why we have tax code A's. That's why there's 9 counties out there where there are cities that are lower, and they do keep it at that, and then that difference gets paid to the county. But yes, in your scenario, if it's at 10 and the county went to 11, could the city come in next fiscal year? They couldn't do it that. It's going to be, because you can't change it mid-year, but the city could come in and go 1% higher than the county. And for 1 year, you would have a tax code A situation where the county would get that 1% because the 10% would go to the city as a credit, and then the county would get the 1%. And then if the city wanted to, it could come in and go 12% or even 11%, just make it even to where it's at. That's kind of how also Jefferson County has got a lot of those own rule cities like St. Matthews. Again, St. Matthews is smaller ones. They're all at 5% for that reason. They're all kind of like, if Jefferson, because Jefferson's a blended, it's a city and county tax together. The whole if you're in Jefferson County, you're in Louisville, Jefferson County, and unless you're in the old urban area of it, but they're all 5% across the board through there. But if somebody was to change it, it wouldn't surprise me to find out that others would then adjust within a year to match.
Magistrate, it's Rich. The short answer is, going back 20 plus years, if your city has an insurance premium tax, you almost do better to pass a donut hole and pass it for just the unincorporated areas, because they are going to match. It's just the way it is.
Yeah, that's very common language. Yeah, Rich. Yeah, it's very common language in a county ordinance is they exclude incorporated areas of the county, and they just leave that to the cities. That's very common language in a county ordinance.
Thank you. Yes.
And let me see, going up here. In a flat scenario, is the fee per policy? Yeah, it's a flat fee. Just means it's no different than if you do a percentage. It's whatever you're collecting when you pass the policy. It's a flat fee instead of being a portion or percentage of the amount that's being collected.
And John, also, there's another question. What would you repeat what you said about the e-services portal?
Sure.
How's it useful for county governments?
Yeah, it's what you can do is you can log in. Like you say, you have one right now. You could log in now and see how much annual reconciliation has already been, or how many have already been filed with you. And kind of you can watch it. March 31st is the date they have to have it in by statute, but it gives you access to the report that shows what every insurance company has reported to us that they collected in the previous calendar year. And so you can use that against your books that you've collected quarterly. So you've been doing quarterlies to keep track of that. And that's how you do your audit. Again, you won't have a really clear picture till March 31st of the end of the year, because that's when they have and a lot of them, they're filing a bunch of them right now, but we'll get a bunch in March. And because they're finishing up their end of the year, they'll take their 30-day run out and they'll figure out what they collected, remitted, refunds, all that. They're filing their annual reconciliations now, and you'll have all that data. But basically, it used to be before the portal, you would have to contact us, and we'd have to email you or send you a paper copy of that. And now you actually have access to it immediately of what's called the annual reconciliation. And it's just the calendar report that insurance companies have to file with us. Flat fee tax insurance companies are not that's if you're asking, because there's never going to be local government premium tax on an individual ever. So that if it's individual health insurance or individual, you're not going to get that. Is the flat fee assessed every year? But no, again, the fee is assessed whenever you place the policy. So it's when a policy is placed. An agent or a broker writes a policy. That policyholder is going to get what's called a deck page, cover of the policy, and it's going to have a breakout of how much the premium is, how much they owe that municipality if it has a local government premium tax. The 1.8% surcharge is going to be on there, so all that's laid out there. So 9 out of the 44 benefits the county's currently. Hey Jim, are you on here where you can hear me? I mean, obviously you can hear me, but that you can jump in so I can. I'm not sure I understand your question. 9 out of the 44 benefits the county's currently.
So what my question was currently, you said earlier there were 9 counties that were in cities where the city had a lower tax rate. Mm-hmm. So if that's correct, my understanding is, so those 9 counties see a benefit of this system, but the difference in those 2 would not, based on there being an inversion in that rate.
Correct. I see what you're saying. Yeah. So what you would do is because they're actually listed in the bulletin here. So those 9 counties, any of the cities that are in there, you're absolutely right. Those 9 counties are seeing some portion of anything that's inside the incorporated city limits is coming to them. Okay. And they've been pretty static. You don't see a lot of movement, but again, Bullitt County just went to an A this year. So we'll see how many of those stay in A for the 2021-2022 fiscal year. And we won't know that 100%. That's the other thing. The 100 days is when I need to have all your all's ordinances. 85 days before July 1st, I post them. So the insurance companies can then start to update for renewals for July 1st. So I've got a 15-day window when I close it to where I redo the tax schedule, redo the tax descriptions, redo the bulletin, and I get all that posted 85 days before July 1st to make sure that everybody has the new fiscal year information in plenty of time. Other than that, that's kind of a rundown through the bulletin. I think I've hit on most of the stuff we wanted to talk about, but I wanted to open it up and make sure I had time to answer questions for you all.
While you are looking at your notes, John, and maybe revisiting some of the questions, I just want to say that we had a comment from someone in the audience, and he's from Jessamine County, and he said from 1980, someone mentioned earlier, they wondered if there was lost business when a tax was enacted. But he said from 1990 to 2016, he was unaware of any insurance companies that withdrew at least from Nicholasville due to the presence of an insurance premium tax.
Yeah.
And he said there were many more insurance companies paying that tax in Nicholasville when he retired in late 2016 than they even had at the inception of 1990. So that kind of goes to that question that was posed earlier about whether or not it created a loss of insurance companies in the county.
Yeah, it's the one thing that it does happen, and I will handle all the phone calls that come. If any that are new, and we had Jessamine County, who Nicholasville had it, but Jessamine County just went. I think they just had their the county actually just went. I think in the last couple of years. But whenever there's a new county or a new city, I'll be handling lots of phone calls because it'll no matter how much you all post your ordinances at renewal, that's when they'll start to see. Those they'll get their bill, and if it's a 10% rate, which is one I see around, and you used to pay, on $1,000 at 10%, you didn't have it, and now you have $100 more on your premium. So that does come up periodically here and there. But again, it's the times we live in right now. I know the counties and cities are looking for revenue, but. I know I've given you all really a crash course on this, and hopefully I have. And thank you, Bill. I saw that on there. I know I've thrown a lot of information. It does have a lot to it. You really can't cover it all in an hour and a half. I'm more than happy to schedule any time for phone calls. If anybody wants to have an individual time to talk about it, always available. We can set something up to do that. But yeah, just again, thank you for having me. Is there any other questions on this? Again, I know there's a lot that's out there, and a lot of ground we've covered. But the main thing for you, just your procedure stuff, I want to talk about that. Really, it's all about just getting the ordinance into me. If you pass an ordinance, I also need to have the payee and who you want the address sent to. And outside of that, I need a hard copy of the ordinance because we keep that on file indefinitely. I've got ordinances from 1904 that, man, they had some really good handwriting back in those days because everything was handwritten. But yeah, we keep the actual official records of those. You can email me, though, to meet the time statutes. You can send me an email of a past ordinance, and that will meet that 100 days. I'll still need a hard copy mailed to the Department of Insurance. But if I get an email copy of it, that's fine. We can go ahead and then that'll meet the statutory requirement of the 100 days. Outside of that, once it's in place, if you put one in place this year, it'll start July 1. They'll start collecting and remitting on your behalf, or collecting on your behalf. Your first checks will come in within 30 days of the end of the third quarter. So that's like October. And so the checks would come in. After that, that's really it. There's no reporting that the counties have to do as far as with the DOI. I'm not sure on any of that as far as revenue or how that's way outside my lane of traffic. But all we need for the DOI is just your ordinances in place and where to send them and who to send the checks to. And outside of that, that's pretty much it.
Well, John, I want to thank you so much. This has been a great training, a great class. It's been very interactive, and the questions have been really germane. But again, thank you so very much for presenting today. And to the audience, we just want to let you know, we want to thank you for joining us today, and to let you know that we will be adding more classes like this to the calendar soon. So keep an eye out. And if you do not get our Friday e-newsletter, please reach out and let someone at KACo know that you include any upcoming trainings in that.
Hey, real quick, I did see a last minute question kind of up in here, and thank you all it's been wonderful being here. What user type do counties use to sign up with e-services? I'm not sure I understand that. Susan, are you on here?
Yes, the drop down says business entity or individual or insurance or consumer.
Yeah, I need to send you that one. That's why if you need to contact me, send me an email to john.hord@ky.gov. It's a link that I need to send you. I'm going to send you an invitation. Or if you want to, I can call you right after this is over and I can send that over to you real quick.
I'll send you my phone number.
Okay, and I'll give you a call and we'll get you set up. It takes about 5 minutes. I'm going to send you an email. You just click on the link and create the account, and then you're in there.
Thank you very much.
For anybody, just send me an email. We'll set up a time to call. It really is about a 5-minute process. Yep, there you go, john.hord@ky.gov. That's me.
Okay, I hope all your questions were answered today. We tried to keep up with them, but if we missed any, then please reach out and we'll get those answered. So again, thank you so much. Great class.
Thank you all.
I think,
Have a good day.
I think, it was a great class.